Welcome back, ladies and gentlemen. I'm Dominic Pascucci from Signature Homes and Estates.
And I'm AJ from AJC Realty Exchange, your Jersey City guy.
Real Estate 101. We're here to talk about mortgages and the future markets in real estate.
Well, first thing you need is to purchase a property is what?
Get a pre-approval letter.
Got to get it done, because the first thing that you want to do is establish yourself as a serious buyer.
And I mean, pre-approvals are basically a net-to-debt ratio, and it's very, very important to understand that. That's the beginning phases of Real Estate 101, where you have to minimize your debt and expand your net in order to be qualified to even get the ball rolling in real estate. That's the first step. And I don't think a lot of people really have that set. And unfortunately, Bloomingdale's, Neiman Marcus credit cards, $35,000, $40,000 on their credit cards.
You're starting it too early. I'm going to get angry. I'm going to get mad. Don't do this. Not now. Just give me a minute before I get angry.
All right.
Let's just start with that frou-frou crap. Let's just start with the 2836 rule. The 2836 rule of mortgages. So the 28 inside that means that your mortgage payment cannot exceed 28% of your monthly income. The 36 is where people start to say, well, what do you mean by 28 over 36? It's actually a separate percentage. It means your household debt, monthly debt, plus your mortgage payment cannot exceed 36% of your monthly income. So when you're ready to buy a mortgage, we'll start with the 15 or 30-year conventional loan, which everybody hears about the 30-year mortgage. Dom, take it away.
Obviously, like I said, net to debt ratio, that's the first step in anything for pre-approval letters. And then determining what type of finance you're in. Are you in a first-time homebuyer, FHA, or conventional? Conventional is more of a 10 to 12%. You can even go down to even 5% on conventional. The other variables are PMI insurance. Now, a lot of people don't know what PMI insurance is.
Private mortgage insurance. That's the bank's way of saying, I trust you, but I don't trust anyone. And what I mean by that is they're saying, hey, I appreciate the fact that you have the money to put down on the home, but we need to make sure that in case you default, we have insurance. It's a private insurance in case you default on the home.
And basically, that is going to be on there until you hit your 20% mark. Then the PMI will be released.
Your payment, your interest, your taxes, and your homeowner's insurance is all rolled into your loan. Those 4 parameters you need to know as a home buyer are rolled into the loan.
If you're first-time home buyers, obviously FHA is a nice incentive. You know, if you have the capital to go into conventional to make it a little bit more appealing in negotiating a deal, that's fine.
The FHA is a really cool type of loan because you can get it gifted. You have to live there for a year. It is a government-sponsored loan, and the interest rate is we're at around right now 6 to 6.4. Yeah, as of today, they came down a little bit. So regarding, you might be saying, well, what's the difference between the two? Not much. So if you have the money to go conventional, I would say probably do that, because the advantage of conventional, if you're buying a condo, most condos, and I mean 95%, do not accept FHA. And the conventional is really the holy grail of 15-year or 30-year fixed mortgages, and most people go with the 30. The difference with the 15 is you just take the 30-year payment, cut it in half, and you're paying a lot more. So that's why we rarely do them. That's really the difference between the two. But let's move on to
your expertise on your 203Ks that you
203K.
guys deal with in Jersey City a lot.
Yeah, we deal with these a lot because Jersey City has a primary specialty in TLC homes, what we call fixer-uppers, or TLC stands for it needs a little 10 to 11 care. Well, they need a lot more than that. They need full guts, okay? And I mean to the studs. And sometimes that will encompass a large construction cost. The way is very simple. You purchase the home, you add the construction cost, roll into the loan and fix it up without worry. I mean, that's a nice loan.
It is, and it's a nice incentive for people that are really starting in this field of wanting to buy and sell and flip, what have you, in long-term investments. And it's also just so we can let them know that it's usually taking an additional 30 days to probably close.
Yeah, it is a little longer because you have to get a general contractor to come in and do the estimate. And don't be afraid of the tougher homes, guys, because that's where people don't look. Your dream home is sitting right in front of you, and that's where you need a 203K. The 203K it's my favorite loan, as I'm encouraging you to get out of the rental trap and buy the fixer-upper. Get the 203K. Everyone's scared of the 203. Oh, it's a higher percentage. I get it's a little higher, but at the end of the day, you are similarly getting a new house. Listen, you're buying a house at $500,000. Is that a lot of money? Say yes, of course it is. But think about this. Let's say you need $70,000 in construction. New kitchen, new bathroom is around $10K. New kitchen, 12 by 12 is around 15, and another bathroom. You're at 35 plus floors and paint. You need $70,000 in work. What is $70,000 on $500,000? Shungats. Zero. No, let's think about it. I can get a brand new type of house for 70 to 100. You think I'm going to get upset? Do you know what the difference is on your mortgage payment? I'll say it again. I'll say it together.
Go ahead.
Shungats. Nothing. What would you rather have? And guess what? The 203K, hold on, and you're building equity because what did you do? You fixed up the house.
That's right.
And then the curb appeal's better, and people are going to see new appliances.
All right. We can
See
take
what I'm
it easy.
saying? Yeah.
I ain't fighting with your troops.
Let's move on to good old hard money. You want to start?
Our investors are investing long-term investments. They're not looking at a 2 to 5 year turn. They're looking for 20 to 30 year hold. And then basically what they're trying to do is pull the equity out of that property and roll it into a new property. So basically it's its own synthetic finance.
It is, yeah. So hard money is essentially a loan where the interest rate is higher, but it's a very short-term loan. So before I scare you, this is how it works. You're going to get a loan. I'm going to give it to you for 2 years. You're going to pay it back in 2 years with a 12 to 14% interest. It sounds scary, but not for the scenario. The hard money loan is primarily used for a fix and flip or also a partial payment into a larger purchase. I've actually seen splits. They got a mortgage plus a hard money. So let's say you buy a house, you buy this home for $500 and you put in, it's going to need, $150,000 in work. Right. Now it's at $650. Now the equity after ARV, it's projected to sell at $7.25. Let's just say that's the after renovation value. That's where the hard money comes in because you're going to go in, you're going to fix it up, and you're out. That's where the 24 months comes in. You go in, you do what you have to do to fix it, and you're gone. But now this is where the education curve comes in. You need to know how the market's going to shift, and that's where you come and talk to us because it can be dangerous. And for the millennials that go for the hard money, hold on, let's go for. You better be careful. That all that burr crap, buy, renovate, repeat, resell. If I hear that again, I'm going to throw someone out a window. You can't just go and buy homes, refinance, and go out without market knowledge. That's why you have to start with an expert, and then you get to that level. That's why everybody's the shysters are saying, "Oh, just go and start." Can you imagine giving somebody your money to go into a hard money loan and then you owe that in 2 years? No, seriously, could you imagine that?
No.
Hey everyone, thanks for tuning in today. Today we talked about mortgage rates and current market condition and where we're headed. I'm AJ from AJC Realty Exchange.
And I'm Dominic Pascucci from Signature Homes and Estates.
We can't wait to have you and talk more. Our information is below. Reach out to us. And again, let's make a deal. We can't wait to talk to you soon.
Talk to you soon.